Hello and welcome to the Movie Market Podcast. I'm Jay Argonic, and as always, joined by David Sokolowski with his bloodshot red eyes after his new baby this month. Everybody's doing well. Thankfully, David, let's jump into, quite the second quarter and, kind of month of June overall. And as always, let's recap and see where we're going ahead.
Yeah, thanks, Jared. It was definitely an interesting month in the markets and also a very interesting quarter as we saw. So if we just rewind a little bit and just kind of think through, where we were a few months ago. So starting in April, we had a lot of the tariff announcements and tariff uncertainty that really weighed on the markets and saw a pretty significant drop off. And then since that point, and as the market's been looking for more data and confirmation on where activity is actually going, we've seen a pretty robust recovery. And as of the end of June, we've reached all-time highs in several of the market indexes. The S&P 500 has come back to its all-time high, and Nasdaq as well. And a lot of that activity is really being driven by the technology names, particularly in the large and mega cap space. And a lot of it has to do with, the continued strength in earnings as companies have continued to have results that have been better than expected. But another component of that has also been just the weaker US dollar. So we've seen the US dollar continue to weaken. And again, as you have these companies that export, let's say Microsoft licenses or licenses for any US tech company, they benefit from lower and weaker dollars. As you look at other areas of the market, it really hasn't been as exciting. So as you look at value names, they really haven't performed as well. The RSP, which is the equal weighted index, fell further behind the S&P 500, and again highlights how well the tech names have performed. You've also seen smaller companies, small caps, really haven't recovered nearly as well. And a lot of that, I believe, is driven by their inability to raise capital at lower prices. They do end up paying more for interest on their debt, and also just don't have the ability to absorb some of the price increases or some of the uncertainty as well. So some of the larger companies are able to fare a little bit better during this uncertain environment. And then one other area that continues to be a shining light in the markets is international. So we've seen developed markets up nearly 18 or 19% for the year. You've seen emerging markets, catching up nearly 15% for the year. Again, some of those driven by tech, but you are seeing somewhat of a rebalance. And we've talked about this quite a bit. But at some point, international does become a more compelling and attractive area of the market. And as we think back to the early 2000s, we had a significant exposure to international, not nearly as high these days, but slowly continuing to build that up and to build diversification away from the U.S. market, which has performed very well. But on a relative basis, other opportunities are emerging.
Well, David, as you look at the second quarter, really for the year, the market's been very resilient. We had the conflict in Iran. Overall, you had oil prices surge. Oil prices have since now kind of dropped back to the same level. Prior to that, you've had the tariff discussion and challenges overall, all the market volatility, and the markets have remained very resilient. So now, as you turn to the economy, it's, looking at the Fed. Overall, the Fed remains in a tough position relative, but as I've said over the last month or so, I think at some point you got to take a step back and just look at the data. Where are we, right? And as you look at projected GDP from the Atlanta Fed, we're right around 3%. Inflation has had 4 months in a row of, pretty reasonable inflation data points. But then you have the labor market that remains softer. To me, it's in the okay category. It's not great. It's not horrible, but maybe there's some masked weakness within the labor market. So I think it's something for the Fed to take note of overall. I think as we look to the rest of the year, I'd still expect to see the Fed cut interest rates twice this year, depending where the labor market and inflation go overall. And then kind of seeing into, the month of July, which we expect a fairly volatile month, you have a little bit of headwind. I mean, markets are at all-time highs. You've seen the momentum as we talked about coming into June. The markets were break even for the year for the most part. So a lot of the cash that had been sitting on the sidelines outperformed stocks the first 5 months of the year. You've seen a lot of that cash return to the markets in the month of June. You've had a lot of stock buybacks. We hit the blackout period right now ahead of earnings. So that could be a little bit of a headwind, looking at July as well. And then second quarter earnings should be solid, but again, it's going to be all about the outlook overall as we look to the second half of the year.
Yeah, Jaron, as you kind of mentioned the labor market, it's interesting. We've talked quite a bit about AI, and that's an area of the market that's going to continue to drive more conversation and will start to have more impact. And as you look at companies that integrate AI into their ways of working and just using the technology overall, companies are using it in different ways. Some of them are using it as a growth avenue, but really primarily most companies have used it as a way to reduce costs. And so as you look ahead, companies that have not embraced it yet or are still testing it out, we'll see a larger pickup. And we want to make sure that our portfolios are AI proof, right? So that one, you stand to benefit from the technological enhancements that AI can bring, and the operational efficiencies that it can deliver for companies. But two, also making sure that companies that don't, actively use it are in businesses that won't necessarily get disrupted. So as we look in technology, I was looking at some information from a tech company that we follow pretty closely. Their CEO indicates that 30 to 50% of the tasks can be completed and performed by AI. They have metrics that suggest that 93% of the customer questions that are answered using AI agents have a 93% satisfaction rate. So the technology is getting better, and for us, it's more important to one, make sure that companies that we invest in are using it. Two, to really identify avenues to invest in it more directly. So, obviously, we've seen the chip manufacturers, we've seen the storage companies, and all the other components that enable AI. But it's also important to make sure that companies are using it effectively and also finding names where you can have direct exposure. One of the challenges has been many of these are smaller companies, not necessarily public, that provide AI services, but finding opportunities to one, invest directly, and two, just making sure, like I said, that portfolios remain AI proof, that they can benefit from the cost cutting or cost savings that it can bring, but also using it as a tool for growth and driving additional earnings as well.
Well, David, I think as you mentioned, the small cap underperformance, I think one of the challenges in small caps overall is they don't have as much capital as bigger companies to innovate. Because I agree. I think as you look at the second half of the year and ahead, the direct AI companies have clearly benefited, but the indirect, the companies that are integrating the cost savings are picking up faster than expected. In many cases, I think those are the areas of focus in many industries. And as we turn, maybe now to housing, but the back half of the year, you've started to see activity pick up. The question is, will it accelerate? And again, consumer confidence has rebounded from the April lows overall. And I always say, the two biggest factors of consumer confidence in general are stock prices, which are at or near all-time highs, and gasoline prices, which have fallen. So both should fuel, continued resilience or increase in consumer confidence. And when you think about big ticket purchases like a house or a car, you tend to think about that for a few weeks or longer before you actually go out and make the big purchase. So it'll be interesting to see if the back half of the year you see those big ticket items pick up overall. And again, consumer confidence is an important factor as you look at, what's ahead for the markets.
Yeah, Jared, and it's interesting. I've been working with a number of different families, and more recently, the real estate conversations have really been picking up. There are several families that I've been working with that have been in the market for a home. And very recently, I think out of the three people that live in the city and have or are looking for a new house and are moving to the suburbs, two of the three that have been looking for a long time have either signed a contract or are buying a home. One person's closing today, one person's closing in the near future. But it's interesting because as I've been working with one family in particular who is closing on their home today, as they started the process, they were in the kind of 6.5%, 6.75% range as they were starting to get their mortgage. And just as they were going through the process, and like I said, closing today, in the very short few weeks in between starting and getting to the end, we saw their interest rate come down significantly. So from almost 7%, like I said, 6.75, down to 6%. So you're starting to see some of those improvements. And as those rates, stabilize and mortgage rates have gotten better for two reasons. One is because overall rates have come down. We've seen the 10-year Treasury move a little bit lower over the course of the month of June. But you've also seen some of those credit spreads. So the difference between the Treasury and the mortgage, which recently has been a little bit of a higher spread, has gotten narrower. And as a result, and kind of what that means is mortgage rates are starting to improve. Banks have more appetite for writing these types of loans. And so you're starting to see that mortgage rates are now at around 6% for a 30-year, which is very attractive. Obviously, if that continues to get better, you'll see more housing activity, more refinance activity, which will put some cash into the consumer pockets and hopefully strengthen some of the consumer spending, which our economy relies heavily on.
So David, as we kind of close to look at the back half of the year, to me the big thing to watch for is consumer confidence, right? I think what we've seen over the last 8 weeks or so is investors, businesses have kind of tuned out a lot of the noise, focused on where things are, and you've seen this dramatic pickup. So that to me, the question to watch for is, are we running out of cash to push the markets higher? Or is consumer confidence going to continue to drive future growth, future spending, and activity to have another leg up overall? And again, I think July is going to be a very interesting month with all the news to watch this month and see where we are. So with that, I want to thank you for tuning in, and I think we'll have a lot more to talk about at the end of July.
Thank you.